Um, Welcome to our community call 13. This session is intentionally a bit different. Um, I think we are not here really to make a specific workshop or specific framework. We are not really pushing a particular summer improvement proposal. Today is about zooming out a little bit. Lazy Summer has officially completed the first year, and before we rush into what's next, I think it's important that we pause and acknowledge what has actually been built. Really, direction only makes sense if we understand our starting point. So, that being said, I think before we talk about where we go, I would really like to spend just a few minutes grounding us into what's the present situation right now, because the first year wasn't just growth, it was sequencing. Our 12 months, over the 12 months, the Lazy Summer protocol recorded over $834 million in cumulative deposits. At peak, we reached nearly 198 million in TVL, and we generated over $509,000 in protocol revenue directly from strategy deployment and on-chain activity. And that distinction matters. Revenue here was not just purely driven by emissions. It was not driven by token inflation either. It was generated through usage, through capital being deployed productively. And when we look at today's TVL, around $50 million, it reflects broader market rotation, but the structural layer underneath that capital remains fairly intact. Now, one piece that doesn't get enough attention is Beach Club. Beach Club rewards or referral program that Lazy Summer DAO has approved wasn't and isn't just a referral program. It is fully on-chain, auditable growth layer. Over the year, nearly $94 million in deposits were attributed to Beach Club participation. At peak, it represented more than 15% of the total TVL, and payouts were transparent. A little under $10,000 USDC dollars and over 300,000 summer tokens has been distributed to referees. The important thing here is that growth incentives were measurable and structurally aligned. They scaled with participation, not speculation. And that's different growth philosophy than most protocols chose, in my opinion. Then there is staking, or rather conviction, as I'd like to call it. Today, more than 128 million summer is locked, representing almost 29% of circulating supply, with an average lock duration of 642 days. And what stands out even more, nearly 45% of locked summer is committed for more than 2 years, and that's great. And I think that really tells the story here. It's not a short-term yield farming behavior. That's structural alignment, and notably, staking growth accelerated after upgrades, not during euphoric market peaks. That suggests participants were responding to architecture improvements, not just price conditions. Governance here tells a similar story. In 1 year, 119 proposals were introduced, 97 executed. I think that number is even higher right now with the latest proposals being executed as well. We had recorded over 184 unique voters, participation growing steadily month over month. And governance really didn't remain symbolic, it matured in phases. First, we formalized infrastructure. We established the RFC to SIP to vote structure. Then we formalized risk, caps, guardian roles, transparency dashboards. Then capital allocation moved from product managed to now open for governance ready 5 and governance risk managed roles. Launched just yesterday. If you haven't caught up on that, make sure to check out Summerfy and let us know what you think. When staking V2 and transferability sequencing emphasized timing and liquidity design instead of rushing token activation. That progression wasn't accidental, it reflected discipline. And importantly, when friction occurred, like the Arbitrum USDC vault situation, we didn't hide. We published postmortems, we documented retrospectives, Volcanoitica has shared their thoughts as well. We adjusted parameters publicly, and I think that's important here. The discussions they still and will remain open on the forum, and that's where the governance takes place. Maturity isn't the absence of issues. It's really the ability to respond structurally, and I think that's important. We keep that in mind. So when I say state of the protocol, I don't just see the TVL. I really see governance that scaled before capital, risk that was debated openly before expansion, token alignment that reflects long-term positioning, and growth mechanism that are measurable and transparent. Now I'd like to turn this into a discussion prompt. Looking at all of this, capital formation, staking conviction, governance evolution, risk formalization, what do you think is the most underrated achievement of the year one of Lazy Summer Protocol? And of course, equally important, what do you think, where do you think we underperformed relative to potential? I would like to open that up to all of you guys to chime in. Is there anybody who would like to start? Yeah, Brian, I see. Please go ahead.
Personally, I would say not really like lazy summer failure, just sort of after the whole DeFi, contagion that also hit us. Yields on lazy summer were kind of compressed. That was the only complaint. Not really a complaint, issue I would bring up. We weren't delivering the best, yields we could possibly, give out, considering we are technically a yield aggregator. But on the flip side, DAO-managed vaults just launched. They look really good on the interface, on the lazy summer front end. Like, they look really good, much better than I had envisioned in my mind. So big shout out to the team for finally pushing that through. I think that is, it's already like I just came from checking maybe an hour ago. It was the yields are on USDC at least are already outperforming, I would say, sort of the market benchmark. So that's really good. So hopefully, we continue to attract TVL. Obviously, as you said, market sentiment right now is not great. We've been in extreme fear for months. We built during the bear, and once more people start flowing in, I think the DAO managed vaults will be a very good, very attractive entry point for capital, like on-chain capital, especially because all you need is to hold USDC. The other suggestion, and I've made this before, is it would be nice if we could somehow integrate Summer with like wallets. People obviously, like, wallets are the customer-facing, are the most customer-facing product in crypto. yeah, if we could somehow get people like, hey, earn like, this much with, those stable coins you're hoarding in your wallet, that would be really nice.
That's right. Thank you for this input. Yeah, I think what I really like personally here as well is that the base layer exists, right? This is something that we have solidified over the first year, and the vote framework is pretty formalized here. Of course, now talking about the one that is managed risk created by Volcanomica. Super excited. As you also pointed out, the DAO-managed vaults launching just yesterday, and they do look great. I was actually just checking as well myself now on the UI, and it seems like the USDC is already at 7.67 APY, and additional almost 7.5% on the summer right there, which looking back at the more risk averse vaults they are offering on mainnet under the high risk around 4.6. So that's quite a difference there, I would say. And of course, this is just the beginning, exploring the initial strategies there. Is there anybody else who would like to chime in and maybe reflect a little bit on the year one of the protocol?
One question I have is, to what degree do you think so I've been thinking about the interim, but the market sentiment comes and goes. So I think the DAO-managed vaults are a great setup for when the sentiment sort of shifts more so, and we should those will always be a top performing vaults. So I'm not too concerned about that, and it's just a matter of talking about it, in my opinion. But I wonder to what degree the protocol is really just tethered to the sentiment of the market, and if there was anything from the previous year that sort of outperformed while the market was, sort of like meddling along. So that's I'm not sure if anybody has an answer to that. Basically, because I think that will probably be important to try and do things that allow for deposits to come in, whilst the market is, let's say, flat to down, or down only. So, yeah. Not sure if anybody has any thoughts on that.
Yeah, I would jump in and just say like Bitcoin was really the only thing towards we can say since 2024, 2023, 2024 that that was really, that showed outsized performance compared to everything else. So, but obviously we've discussed this many times before. There's not like that great of yields on Bitcoin. So yeah, I don't think, from my opinion at least, I don't think there's anything, the protocol could have added that could give any significantly better performance than what was already there. And yeah, with the addition of like DAO-managed vaults, I think that's a very good position. Like the current regime and probably future regime will mostly reward people who are earning yields on stablecoins, or people who are mostly in Bitcoin. Occasionally there's a rotation to ETH, but yeah, I think those three verticals are, where the highest growth is achievable. So I don't know, maybe hopefully we see some better yields on Bitcoin and maybe get that as a product at some point. Yeah, I think like 70%. I'm not sure what Bitcoin dominance is currently, including stablecoins. It is sort of most held, most liquid asset. So there's a good amount of TVL that can be absorbed if we were to have a BTC fleet, but obviously there's no point of having it just for the sake of having it if there's no meaningful yield to give people.
That's interesting. So basically it's like a new assets as a growth vector that is not correlated to the market. So it makes me think about maybe new networks as well. Yeah, we did Hyper EVM, obviously. That's interesting. Okay. Cool. Yeah, I guess the other thing from my perspective is I think it's really comes down to two things. Differentiation. Is the product better and more useful? And then also distribution. Do people know that it exists? I think those are basically the two things that really matter the most. And I feel that especially with the DAO-managed vaults, the differentiation is more or less there. Like pretty much any worthwhile yield that you want to do in DeFi, more so with like you'll be able to do, I think, on Summer now, especially as the DAO-managed ones, support things beyond morpho markets. They already are, but I mean even more so. But I guess the big question is around distribution, and I wonder, what are the avenues to get better distribution from now on, I guess. So I think that's an open question for me as well. I think the Beach Club is a good call out.
Yeah, exactly. I think with the Beach Club, we definitely saw a great performance on that program and seemed like loads of deposits based on that, and actually quite a sticky deposit as well, I would say, as the incentives flow in as well, and also denominated in USDC for the people that are referring those. So it's not just directly correlated, let's say, to summer inflation, right? As I would imagine is most of the time the case when it comes to referral programs in DeFi. I think talking about growth vectors, I think this is a really good point here, and maybe I would like to bring one idea here that has been I think flowing around for a while as well. One of the, I think, realistic paths here, and okay, for a little bit of backstory. To me it feels like when you are looking at different users, and I guess this is also something we could have observed, or we did observe in November. Users that are like, let's say, high value users for the lazy summer protocol and that have like large deposits, we can clearly see that once liquidation starts to happen, maybe they have their own groups set up and they have to essentially withdraw to cover or recover their positions on the market. So that's definitely something we can see, right? But at the same time, if we look at the behavior of other DAOs in the DeFi space and how their treasuries react to market moves, it's not necessarily correlated, in my opinion, because these are usually not actively managed positions. So DAOs are just holding stables, that they're using for payments, they're using their tokens, of course, and they're holding ETH very often, but they're not actively managed. So here, my thinking is that maybe one of the realistic paths here is also maybe a deeper integration with other DAOs and their on-chain treasuries. I think Lazy Summer has kind of like demonstrated something many protocols haven't. It's like this transparent governance around risk and capital deployment. That makes us structurally attractive to treasuries that don't want to build internal yield teams or directly like pay out specific teams that would just simply focus on their treasuries, which kind of Lazy-Sound protocol, solves for. It's the set and forget part of the story here. So one growth vector maybe is not directly connected to retail, but it's becoming the allocator of choice for the DAO managed capital. And here talking specifically about the outside DAOs. Jordan?
Yeah, that's a great point. I really love that. I wonder how many, do you know how many, off the top of your head, I guess, but it's a great point. Do you know how many DAOs there are that have, let's say, capital or treasuries over $1 million? And then, yeah, let's say over $5 million actually. And also, do any other similar things come to mind from you? Like, I think the underlying thing there is, where's the capital? And do any other cohorts come to mind of this notion of where is the capital? So, for example, I looked at an analysis of wallets in the top 3 borrow lend protocols, and they're about 5,000 or 6,000 wallets, and the capital is distributed majority to the ones over I think almost 90% of the capital is over 100K in total. So it's definitely a power law. So I wonder if any other cohorts that are similar to DAO treasuries come to mind for you that maybe we could also target, that are an explicit target with a very clear set of needs, basically. Maybe funds, or not sure, but yeah.
That's a good question, and of course it's a bit hard to just point it off the top of my head. But there is one tool that I keep going back to, and I hope that they are reporting correctly these values. But just to have an overview, this is a deep DAO analytics, and so what I can see here is Mental, of course, formerly Big DAO, is one of the largest treasuries, right? They have over 3 billion in their treasury. Uniswap, of course, it's like the major ones, right? The Uniswap, the ENS DAO, the Gnosis DAO is fairly huge. These are all well over. Oh yeah, wait, sorry, I will share this right away. Here we go. Yeah, so if I would just say off the top of my head, I remember this case fairly recently, right? Gnosis DAO has been overboarding their treasury manager, which was KPK until recently, and I think another maybe pointing case could be Arbitrum, which is now really employing essentially a large service provider that are basically taking care of the treasury and the treasury allocations there. Yeah, according to this DAO, even though they say that it hasn't been updated, but seems like it's yeah, okay. Well, it hasn't been updated, so I don't want to call the specific amounts there, but I think it gives a good picture on what the treasury, the size of the treasuries could be around. Yeah, Brian, please go ahead.
Yeah, I just wanted to say, that's a great, your idea of onboarding treasuries. Genius idea, especially because over the past year and 2025, a few DAOs have sort of, as you said, offboarded treasury managers because in essence, they were charging, management fees on TVL for, and I forget which DAO it was, but some of the contributors essentially said, we're just paying someone millions of dollars for, depositing into Aave. So there is real appetite for DAOs with treasuries to, sort of deposit in a set it and forget it strategy like Lazy Summer. So that is, a good growth vertical, especially because it will be in stable coins, and there is a good chance that it's for a long-term commitment. And as you said, Deep DAO has been, I'm not sure if it's deprecated, but they haven't been. Historically, it hasn't been that reliable, but looks like they are not even updating data currently. I shared a link to DeFi Llama. I'm not sure how accurate that is, but seems to have just a bit more, slightly more data sources, which good call out on the DAO treasuries.
Yeah, it seems like what could be perceived maybe as one of the difficult points when it comes to DAO treasuries is for them to have a full transparency in what's going on, and of course not having all their eggs in one basket, right? And I think this is also something that really Lazy Summer protocol provides with, right? Like by default, like all the vaults, they distribute capital, so this is not like set and forget into Aave. Of course, nothing against Aave, it's a very battle tested protocol here, but I think also just throwing it there and then charging a crazy amount of fees on top of that based on the TVL, it just becomes quite cumbersome, I think. Maybe from another perspective, it could be also slightly difficult to reach, or not difficult per se, but maybe it just takes a longer time, because if the treasury, usually when the treasury of a DAO is large, the some of the governance processes can become cumbersome. You really need a very strong foot into the DAO to sort of course, follow their processes, to make a proposal and then get it out there as well. So a lot of strong comms and sort of trying to pull strings, trying to see who are the delegates, bringing this into calls, maybe making some Twitter spaces, let's say, or something similar, just to really bring attention to that. But I do feel like this could be an interesting avenue to explore down the road. Making sure, of course, we have the reporting discipline. So again, like maybe there is a way how we could set up a working group that is purely focused on that. I think there is quite a strong need for more and more sort of working groups when it comes to yield sourcing for different vaults, also specifically for the DAO-managed vaults. I think it's really great that we also have the Guardian set up now in place. So in case something is not going as it should, then we have this like really strong backstop that can prevent large losses for the users. And I think that's yet another sort of a security aspect that for example bigger users or DAO treasuries could tick off their list, like as more like sort of secure place to deploy their capital. I think DeFi Llama, of course, is great for an overview. I'm just looking at the numbers also, that's why I'm speaking a bit laggy here. But maybe this is something that we can explore and see where it makes sense, and try to structure some proposals. One thought as you were speaking, Brian, also that crossed my mind was the fact that maybe part of this pitch, and I don't know if I'm just talking smack right now, but I was just thinking, if a DAO allocates their USDC into the lazy vaults, and they do get the receipt back, right? They have their token sort of back. So this would be the LV USDC token, let's say, right? And in case that a DAO needs to make payments, this is still, a backed token. So also their payments could be denominated in LV USDC tokens. And I think that's maybe something that could be also explored here, because really, then there is even less need for them to sort of go back and forth and withdraw positions and care about like instant liquidity in some higher risk strategies, because there will provide, sort of I don't know if I'm going too far by calling it a yield-bearing stablecoin, really, LV USDC as a representative of that. Do you guys have any thoughts on that?
No, it's your take is accurate in terms of like yield-bearing stablecoin. It's it's the whole reason DeFi was formed, just so there's money Legos pretty much. The DAO can earn a yield on stablecoin reserves and still use sort of those reserves to pay contributors, who can decide to continue earning that yield or cash out. So it's a very as I said, it's literally why DeFi was built. So it's a very good idea.
Another note actually that I made some time ago, and I think it has been discussed also previously, or I must have got inspired somewhere, was the ability to lock your position in lazy summer, right? So right now you deposit USDC and it's there. So I was just wondering if there could be a way how to stake those deposits for further rewards. I'm not really sure. I haven't made the token planning around it, just again as a thought, but I know that some protocols are offering like sort of additional yield on staked deposits. I don't know, maybe Jordan, is it something that you thought about or that you observed, or do you think there would be an appetite for that, and if it would be helpful for the growth going forward?
I haven't really thought about it. That's an interesting suggestion, though.
And just another interesting selling point would be like you're basically it's an indirect way of hiring Block Analytica as your treasury manager. So you really that 1% fee you're paying is it's an indirect way of having like Block Analytica as your treasury manager. Alternatively, there's the institutional vaults. So if a DAO is very, ones are not happy with the current strategies, they could always pick up their own in the institutional vaults.
That's very fair point as well. Right, like let's say a DAO is even more risk averse. This doesn't prevent them from utilizing the infrastructure of lazy summer protocol, right? Like through this institutional vaults, we can actually create a very custom solution for them. So they can essentially say, okay, we would like to allocate to this and this and that. We don't want to go full on in Aave, but maybe we want to have an exposure there, then this specific market on Morpho, and they can essentially set up their own structure. And again, this could be purely just for them. It can be also open for, and now I'm just like imagining what could be, some like token gates that could be utilized as you pointed. Also, DeFi, was made to utilize this like DeFi Legos here. So let's say an Arbitrum says, okay, we want this and these strategies in our vault. And we also allow other depositors. So this would be Arbitrum users, let's say, as long as you are holding, again, top of my head, 100 ARP tokens, you can access this vault as well and earn with us this yield. So I think that could be also something to explore there. But yeah, very fair point to bring sort of institutional vaults also in the picture of DAOs and sort of approach it as more sort of custom solutions for them to explore. I guess maybe even the risk management, right? If they have a risk manager already in place, that risk manager can be brought into the institutional vault for them to sort of manage their risk if they, let's say, wouldn't want either Lazy Summer DAO or Block Analytica to represent the risk management there. They can bring up their own as well. Yeah, these are, I think, all very interesting thoughts here. Maybe I know this has been mentioned, like sort of this the idea of vault expansion and the risk postures. So maybe mentioning here that again, as the DAO-managed vaults are becoming operational, the governance has even more expressive power, I guess, over the risk here. So there is some sort of a separation right now between the more conservative Block Analytica created vaults from like really these governance directed vaults. I'm wondering how aggressive should governance be in the year 2 when it comes to this DAO managed vaults, DAO risk managed vaults. So should the DAO really reflect higher conviction and sort of differentiated strategies, or should they remain only incrementally more flexible than the conservative layer? How do we ensure, that incremental expansion doesn't sort of slowly drift into risk creep over time? Do you guys have any thoughts on this topic? I know that Jordan, you have been working hard on the DAO risk managed vault, so maybe this is something you have some thoughts on.
We should be aggressive, basically. I mean, certainly it poses risks, but that's what the risk framework is for. And I think that the people who are putting their capital into DAO risk managed vaults are cognizant of the risk. And I basically think it should be a little bit of a barbell approach where the risk managed vaults can be conservative as they have been. And I think that they have almost unequivocally become more conservative after the November thing and November incident, and it's just sort of like a scar tissue in a way. Like if you like PTSD, like if you go through some trauma, like you're probably going to be more hesitant in the same context moving forward. And I think that has basically happened with the actively managed vaults. So I think those should be more conservative, and they generally have been more conservative to date after that. But on the DAO risk management side, I think it's sort of a barbell where we should be much more aggressive and onboard stuff. And as soon if it hits the categories, onboard it. For example, today I'm probably going to put a proposal for the Sky Rewards risk capital that is in Morpho just a couple of days ago, for example. And I don't think that would make it into the actively managed risk vaults, but the DAO managed vaults, I think, we should go for it. So, and that I think will spur a lot of growth. So, yeah.
Of course, it's super important, and I'm so grateful for Balkanutica to creating this risk framework. I think as long as we follow the risk framework, uh, we should have a good overview of what actually is getting in and or what has to get out of the DAO-managed vaults. And I think this stands of a more aggressive strategy. And I guess it's actually of a great value to have a more conservative vault and to have more sort of or less risk-averse vaults there that could attract simply different types of users. I feel like most yield protocols kind of compete on headline APY, and I feel like maybe we as a Lazy Summer protocol, we've competed more on structure. And what I'm trying to say here is kind of thinking outside of this room. When you are asked why Lazy Summer protocol, why to use Lazy Summer over alternatives, what is it that you guys say? What is your take on why the user should come to Lazy Summer? Is it like the staking element? Is it Beach Club? Are you showing your own Beach Club rewards, or are you bringing them onto the fact that they can be rewarded if they bring more rewards in? I think I would just like to hear some of your thoughts around our differentiation, really, because I feel like that framing kind of shapes the strategy that we can also take forward.
So I can give sort of my personal journey, how I sort of started interacting with Lazy Summer. So it was obviously like I spent a lot of time in 2024, 2025, sort of, I do have, a risk position like in Bitcoin and ETH and other stuff, but I also maintain a cash position. So it was like, what is, the best way to sort of beat, not beat currency debasement, but also like, not let inflation eat away at the USD denominated assets that I was holding. So Morpho was, sort of the star of 2025. So I did spend some time like rotating in and out of different Morpho vaults. Eventually that did become tedious, which, eventually like led me to Lazy Summer, where it was like, there's, a bunch of different strategies here, including strategies that involve protocols, which I did not have the time to study and like understand properly what the risk trade-offs were. So it was, an easy way to get yield while diversified in projects which I did not necessarily have the time to do due diligence on. Another very attractive factor was obviously the summer rewards, and I'm sure like that did drive, I'm sure, a lot of TVL as well. The rewards, the API on the rewards was very high. So yeah, I'd say that is my journey. Like basically I did get tired of like flipping in and out of different Morpho vaults, and summer just presented a much more relaxed strategy, and obviously earning summer was a huge benefit. The only thing, obviously, as I said, I did have like various crypto positions. I was just not able to, sort of deposit more of the crypto assets I hold, namely just BTC. But just BTC. But ETH was available, USD was available. So that is, which is why I also like to bring up the wallet integration thing, because there's a lot of people who just want to hold USDC, but there's too many options in terms of like yield, and that's literally the customer. That is probably our biggest customer segment.
Thank you so much for that. I would just like to share a small part as well, and then hopefully we can hear some more thoughts from you guys. Like, what is your take on or how are you telling other people about the Resistance protocol? I connected to what you were saying, Brian. You mentioned the wallet integration, and actually, this is something that I have been trying to draft for a while now, and I'm hoping, I'm pretty sure today I will be able to post out the first bounty. You know that now on the forum we have a bounty section, and I would like to propose an idea there, and it's basically around creating a mini app. It seems like, you know, for wallets to get the integration, they want to have like kind of a smooth sail towards that. So basically, I want to propose this as an idea for a potential bounty and the ways how that could be developed, and then hopefully we can attract some. I mean, of course, internal or external developers to have a look at the bounty and see if it makes sense for them to help us sort of bring this into the light. I think it would be great. I did see, you know, a couple of wallets already offering yields, and they usually, you know, of course, go either directly towards Aave or they go towards Morpho. But this is also quite a stance that they have to like actively monitor, right? As a wallet service provider, I imagine that you kind of, if you're offering yield through Morpho, okay, it's this strategy, and then okay, maybe we have to like there is always an active management that has to go into that, and I think again this is a benefit of lazy sound protocol. Me personally, even before getting actually much before getting involved with the labs team as well, I found myself firstly in a state of mind where I realized, listen, you are no good trader. And this is I think and often a realization of many people. You kind of realize that, oh, okay, you know, maybe I can trade here, I can trade there, and then you realize, wait, I have a full-time job. Like, this is yet another full-time job, and if you are trading stocks, you know, they at least stop on the Friday, but there's no closing in crypto, so you just have to constantly check for news and for everything, and then trade, and then hopefully, you know, you are breaking even and then slowly growing, but not necessarily my case here. So I was like, okay, you know what, I'm just gonna keep buying, I guess, and I will keep holding, and that's pretty much it. And then secondly, I realized, you know what, like, why am I just holding it? Like, there is DeFi, right? Like, let's make sure, you know, it earns some yield, so it's not just sitting idle. And then I realized the same thing. So I was actively jumping from one DeFi strategy to another, constantly on chart, seeing what offers the highest yield. And I realized, wait, I'm literally doing the same as I was doing before. I have a full-time job. I cannot, you know, afford to just doing that at all times. It's simply not sustainable for me. And then discovering yield aggregators, and then discovering Lazy Summer protocol as a newly launched product, because of course I was a follower of Oasis before, and sort of the Summerfy Pro product, and that was super exciting for me. So I was like, oh, these are pretty much, you know, the strategies that I was hopping one between one and another, but now I don't have to do any of that. So I just deposited and then was super excited that the summer token was launching, and yeah, I believe I was one of the first sort of delegates coming onto the tally and registering myself as a delegate for the DAO, and I think that's how my story started. So essentially, when I'm speaking to other people around or about DeFi, and then sort of getting to a lazy summer protocol, I tend to say that simply, if you have a full-time job but you still want to earn yield and you don't want to keep checking the charts, I think this is a way how you can achieve that. And of course, making it fully transparent, I think, is super beneficial. So this is maybe another point that I like to bring up in those discussions, and that's mainly around the fact that it's kind of like this governance-led capital allocation, right? It's not that, trust me, bro, one, two, three people team sort of deciding, okay, these are the things that, these are the strategies that your money goes, and then they're doing some deals, behind the closed doors. Like that's awful, and there is way too much of that in DeFi. So yeah, this is definitely one of the things that I personally like to bring up. Is there anybody else that would like to chime in with your thoughts, and how are you talking about the lazy summer protocol? What do you think is like the main differentiation of the lazy summer protocol compared to other platforms? There are no wrong answers here.
And just to add to the wallet thing, one thing, like Hyperliquid is sort of what gave me, inspiration around this. If you use MetaMask or Zero and Phantom as well, I think they just integrated perps, and it's literally just Hyperliquid in the background. So, and I think maybe 10, 15, 20% of like volume that goes through Hyperliquid is through the wallet integration. So it's yeah, as I said, it's a great vector if you can capture it to like meet people, like meet new users where they are. They don't need to sort of pick between Lighter or Aster or DYDX. They just have it on their wallet, and yeah, just works.
Is this maybe specifically, just to mention maybe a few or some off the top of your head? Is the Hyperliquid directly integrated in a Rabi wallet? Is that correct?
Rabi, I'm not too sure about, but MetaMask and Xeon, which are the two I use most, they have direct perps integration. They don't really mention Hyperliquid anywhere, but with Xeon at least, it does show my, even though I've never used it on the wallet, it does show my history, my Hyperliquid history. On the on the mini, if you can call it that.
Yeah, that's super interesting. Yeah, I think yeah. Again, I think we should try to think of all these sort of potential integrations and features that could really expand and grow the protocol to shaping them into bounties, right? Like there is a treasury, and of course the treasury is heavily exposed to summer at the moment, and I think that's good long term. Of course, it's very important that we hold the position, but at the same time, of course, there are tip streams that are coming directly to the vault, and of course to stakers, actually mainly to stakers as well of the summer token, so they are correlated. But I think we should utilize this segment or the category that I created on the forum, focused on bounties, and try to come up with solutions that maybe don't directly, not immediately like sort of reimburse the developers in summer token, so we don't have like what do you call it, like a direct sell of the token, but again, there could be a direct integrator code, like some sort of it's similar to the Beach Club rewards, right, where the integrator receives receives a receives a fee directly from the revenue that comes through the integrator's code. And I think that's even more exciting here for the developers, because they are not just building for the sake of building, but they're building something that can also sustain or sustainably grow into the future with them. Yeah, I'm as I said before, I'm gonna make the first idea post, and then hoping to see some of your guys' thoughts on that, and then we can shape it into a more formal sort of open application for anybody to sort of hop on and try to contribute to Lazy Summer DAO. I think it's going to be a great test. Okay, just so we move a little bit forward, I wanted to mention here as well that now we have like more than 128 million summer locked, with a fairly long average lock duration, as I mentioned before, and that I think signals belief. But this belief, you know, needs to compound into utility. And right now it does compound already into a strong utility, like the revenue share that is coming to stakers of the summer token. I think it's great. And yeah, so far there has been two, and in the beginning of March, there's going to be the third rewards distribution of the USDC. And of course, summer tokens are getting distributed automatically there. But I'm thinking, what else could summer represent in the year two? Do we just keep focusing on the governance weight? The revenue alignment, of course, is there via the staking of the summer token. I don't know, some of my thoughts off the top of my head is sort of like, maybe there's an access to a specific vote type, you know, over a specific amount of summer tokens. Like this could be in a tight collaboration with some strategy providers. I don't know. Again, just kind of thinking out loud here, like what else could be there that summer token would bring to the market. Do you have any thoughts, Brian, here on the summer token and what it could represent going forward?
Yeah, the most the most obvious value driver to the token is TVL. Because the way it's set up, it's it's a direct relationship between TVL and sort of the value of the token. Because the more TVL there is, the more you can earn and since revenue is distributed to the token, so that is the most direct way to add value. As for other ways, I think, yeah, I can't really think of anything off the top of my head, because revenue is, as they call it, the revenue meta, is really the most value accretive method that happens with all other like DeFi tokens right now. So yeah, but governance is obviously a second one, but as we've seen, that is not necessarily a value driver. But yeah, maybe some sort of early access mechanism, but that would not necessarily might not necessarily drive people to buy the token for early access. But yeah, we can definitely like do some additional research on innovative like token mechanisms. Arrow, like the Arrow token is very nice as one that has a very nice like flywheel. It gives you that has like a very nice source of like buy pressure, obviously by Arrow, to incentivize pools and so forth. And then like there's also an incentive to hold. So we can definitely do like additional research on how we can like have sort of like a mechanism like that for for summer as well. Maybe, you know, maybe you can drive higher summer rewards towards certain fleets, you know, maybe, yeah, by summer vote on like just to see on mainnet fleet for, you know, um, let's say maybe there's 5-10% total summer going out to different fleets. Yeah, you can vote to get a higher share of those emissions on a certain fleet. But yeah, just brainstorming here.
No, that's great. It's very interesting because I feel like there are certain parts that Summer Token kind of like resembles of IRL, right? But I think you are bringing it even further than that, and because right, like you have Summer, you buy Summer, you stake Summer. The longer you stake it, um, the the better the yield from the protocol you receive, and I think that's already quite great there. But maybe really thinking about the emissions of Summer. And again, right now, of course, as a holder of Summer, you can exercise your right either to delegate or to vote. And of course, there are proposals that signal where these Summer emissions should go towards. But maybe thinking even how more it can be integrated into that, and maybe there could be epochs, and it could directly sort of, or it could like direct the emissions to specific pools. Let's say this could be also interesting with maybe a more open institutional vaults when it comes to DAO treasuries. You know, these things could be explored. I see Jordan, you have a hands up. Please go ahead.
Yeah, one thing that made me think of just then is, so originally risk managed ones, block BA risk managed ones were supposed to be in tokenized, which this is the why we did the excuse me, why we did the LV tokens and all that, so that they could be used as collateral. Which in hindsight made sense. Currently, that approach doesn't make sense for the BA risk managed ones, but I think TVL is a big thing with respect to the underlying token. Also, of course, the liquidity and stuff and all those incentives that Brian was talking to, but it's all correlated to each other. But maybe it's for Dark Lord. Maybe he has thoughts on this around the DAO risk managed vaults. These are perfect for levering up. These are perfect to be made as collateral. So I wonder how we could maybe do this. Because I'm not sure exactly how it works in terms of getting a market, like creating a market for that. But yeah, that's one idea. So for example, because like the USDC DAO risk managed vaults, if those are collateral in, let's say, Euler or some other borrowland protocol, and that market has a bunch of liquidity, then yeah, it becomes an extremely attractive strategy to lever up on the underlying yield. But I'm not sure how it works, so maybe somebody else, if they could run with that idea and let me know if it makes sense. But yeah.
Not sure if Dark Halaprix has clocked in the question here. But I think either way, it's definitely interesting to explore, and I do remember sort of bringing this idea of the, or like tokenizing the vaults to use for as collateral and maybe levering up. Something that crossed my mind and I typed into the chat was stealth repaying loans. Again, I'm just shooting from the waist here, but I was thinking like, I don't know, maybe there is a way how maybe going back to like sort of locking of the LV, let's say LV ETH, you lock, you are convicted, right, that ETH is going to go up. Therefore, you lock for a specific amount of time your LV ETH tokens and you borrow USDC against it. And of course, you have to repay for it to get unlocked, and otherwise, as long as the loan works before you get liquidated, of course, it's kind of like self-repaying loan, right? Because it earns interest. It's not the interest that you directly are getting, but this interest is used to slowly chip off from the loan. So this is just something that crossed my mind now. I don't know, technically speaking, how that could work, but yeah, this is something that crossed my mind now, Jordan, as you were speaking. I know that sort of self-repaying loans is not something completely revolutionary, right? It has been explored multiple times in the space, but I'm just thinking, how to make further use of this idea of tokenized vaults. And I guess when you are saying lever up on it, it essentially means that somebody has to accept, like a DeFi protocol has to accept LV tokens as collateral, based on which the user can borrow against. Is that do I understand it correctly?
Yeah, I mean, accept is not really the issue because they're permissionless, so you can create markets for whatever, really. I think the big thing is that you have sufficient liquidity to borrow against the collateral. So if you have LV, I don't know what the asset is called, but let's say it's LV USDC or whatever. Then you want to be able to borrow, whatever the pair is. Maybe it's USDC, maybe it's USDS, maybe it's USDT, and then you want to have ample liquidity so that you can borrow as much as possible against it, and then buy more LV token, and then obviously lever up on the yield, and then you capture the spread. So yeah, that's the liquidity is the big thing. Being able to have sufficient liquidity in the market, and I'm not exactly sure how the mechanics of that work.
Definitely interesting, and it's very nice that that you have noted this. As you guys know, that there's always a recap coming afterwards, and we're gonna have all of these notes written down and recorded. So I think this could be a starting point of further exploration here. I think as we are getting closer to the end of the call, maybe I would just like to share my reflection again. If you guys have anything else that you would like to mention before we jump off, please feel free to raise your hand. Otherwise, I wanted to zoom out for a moment. I guess year one really established the base layer. The year two, I guess, is gonna test the coordination, right, with the DAO-managed vaults becoming or launching yesterday. I think going down the road, it's much harder, I think, to coordinate capital, to coordinate the risk, to coordinate token alignment and governance at scale than it is to launch. But we have a very strong infrastructure, and I'm extremely happy about that. We have a capital formation history as well. We have a governance participation growth, and I think these are all very relevant and very important aspects of a future growth for the Lazy Summer protocol. I guess some of the questions, popping out down the road are going to be: can we align ambition with discipline? Can we grow without sacrificing the structure? Can the governance remain thoughtful even as activity increases? Maybe one point also to mention here, as as I think one thing that I also appreciate a lot on what has been done this year and the way we approach things is that um, is really that um, the sorry, I got scattered a bit, but essentially what I wanted to say is that even with the uh, market going up, let's say towards October last year, we haven't really, forgot about our risk creation. We haven't really just went degen to like different launches and like got super pumped on the hopium of the market. We just kept grinding and we kept working as intended. And I think that's a great feature of us as a DAO and of the summer protocol. I think to briefly mention here again, today wasn't really about arriving at the sort of final answers. I think I'm super appreciative of the fact that we have opened up the questions. We have explored, some of the thoughts. Thank you very much for everybody that has attended. I think we are here starting a discussion. And we are deciding what kind of protocol the lazy summer protocol will become, right? Conservative allocator, as it was in the beginning, a governance-led capital coordination layer, is it a differentiated sort of yield infrastructure platform, um, um, a treasury deployment partner for other DAOs. Again, I think this was a very great discussion point there as well. And I think those identities won't be decided in a single proposal, right? They will emerge more from like the direction we collectively reinforce over the next months and over the next year ahead and years ahead. So I would like to ask everyone to continue this conversation on the forum, to start threads, to challenge assumptions as always, bring concrete suggestions, make use of the bounty segment on the forum, and try to get some new integrations going and attract more developers into the space as well of our discourse, so we can progress into the future. So year one, build the foundation. Year two defines the trajectory, and I think this is an important to take away of this call. So again, thanks everyone for engaging thoughtfully. I appreciate the time and the seriousness the community brings here, and let's keep building into the future. And see you on the forum and on the next call soon. Thank you, everyone, and have a lovely day.